The Property Bulletin by London Property, the home of superprime.
As BNPL becomes increasingly used for home-related purchases, furniture, renovations, appliances, BNPL lenders and affiliated merchants, including developers, agents, and PropTech platforms, will be affected. Key takeaways. Third-party BNPL providers must be FCA authorized and run affordability checks. All marketing and promotions of BNPL offers must now be approved by a regulated firm, affecting real estate firms who offer finance options via BNPL partners. Merchants, like interior fit-out firms or agents offering BNPL for services, are exempt from direct regulation unless activity happens in the consumer's home. New consumer protections include access to the Financial Ombudsman Service and Section 75 refund rights. What you should do: review any BNPL-linked offerings, particularly if they are promoted alongside property sales or home services. Prepare for new agreements and compliance costs related to financial promotions. Monitor for mid-2026 implementation, as rules are finalized over the next 12 months. The bottom line: this is a key shift for real estate businesses offering consumer finance, aiming to strike a balance between consumer protection and continued access to flexible payment options. Divorce may mean splitting assets 50-50, but for many women the financial aftermath is far from equal. New data from Legal in General shows women's household income drops by 50% after divorce, compared to 30% for men. The biggest reasons: unpaid care work, career breaks, and missed pension rights. Real-life cases highlight key issues. Isabel, a Berkshire mum of 2, gave up her career to raise children. Years later, her divorce left her with a fraction of her ex-husband's income and little long-term security, despite an even settlement. Grace, 48, waived her right to her husband's pension and future income just to afford a deposit and move on. "I feel incredibly ripped off, manipulated," she said. The overlooked asset: pensions. Despite being one of the 3 key assets alongside property and savings, pensions are frequently ignored or waived. Only 11% of divorces last year involved a pension-sharing arrangement. Why it matters in real estate. For many divorcees, the family home is the priority, but this can mean giving up future financial security. Without pension access or adequate income, long-term affordability, including mortgage repayments, renting or retirement, becomes uncertain. Experts and campaigners say the law needs urgent reform. The 1973 Matrimonial Causes Act is under review, but in the meantime, knowledge is power. Top tip: if you're going through or advising on a divorce, make sure pensions, housing equity, and earning capacity are all properly valued, and never assume equal means fair. The UK's National Crime Agency, NCA, has frozen nearly £90 million worth of prime London property linked to 2 men tied to Bangladesh's former ruling elite. Ahmed Shayan Rahman and Ahmed Shahriar Rahman, relatives of ex-regime advisor Salman F. Rahman, are now barred from selling 9 properties, including apartments in Grosvenor Square and other high-value assets in North London. The properties, held through offshore entities in the British Virgin Islands, Jersey and the Isle of Man, were acquired for between £1.2 and £35.5 million, according to UK company filings. This action follows growing international pressure on the UK to help trace and freeze assets allegedly linked to corruption under Sheikh Hasina's government, which was overthrown in 2024. The NCA confirmed the freezing orders were part of an ongoing civil investigation, with potential for further action. Transparency International, which helped expose over £400 million in UK assets linked to the former regime, has called for additional seizures. Why it matters for real estate professionals. High-end London property remains a magnet for politically exposed persons, often via opaque offshore structures. The case signals increased UK enforcement around illicit wealth and unexplained wealth orders. Agents, developers and legal advisors are urged to enhance due diligence and AML compliance when working with overseas buyers or high-risk profiles. The UK market's openness to global capital is being tested by increasing regulatory scrutiny. This case is a reminder: transparency and risk management are no longer optional. Shravan Bhati Mittal, heir to one of India's wealthiest families and a major shareholder in BT Group plc, has officially relocated to the UAE, as wealthy non-DOMs continue to exit the UK in response to recent tax reforms. At just 37, Mittal represents a younger wave of high-net-worth individuals leaving the UK, following the rollback of non-DOM tax perks and new restrictions on inheritance tax relief for overseas assets. His investment firm, Unbound, which was founded in London, recently opened a branch in Abu Dhabi. This move is part of a broader trend. Egypt's richest man, Nassef Sawiris, is also relocating to Abu Dhabi. Members of the Lazari property dynasty now list Cyprus as their main base. According to the Centre for Economics and Business Research, the UK could lose billions if even 25% of the estimated 74,000 non-DOMs leave. Why it matters for real estate professionals. These exits signal potential high-end property sell-offs, especially in areas popular with international buyers. London's reputation as a safe haven for ultra-wealth is under pressure. Shifts in global wealth flows could benefit competing cities like Dubai, Milan and Nicosia, all offering investor-friendly regimes. The bottom line, the UK's tightening tax policies are driving a slow but steady luxury real estate rebalancing. For advisors, agents and developers, the focus is now on tracking where capital goes next and adapting strategies accordingly. The Leasehold and Freehold Reform Act, LAFRA, aims to simplify and reduce the cost of lease extensions. But new analysis reveals it could raise costs for the majority of leaseholders, especially those with leases between 80 and 150 years. What's changing under LAFRA? Marriage value abolished, a major saving for leases under 80 years. Ground rent capped at 0.1% of property value. Freeholders to pay their own legal fees, not charge leaseholders. However, a lower deferment rate, used to calculate the future value of the freeholder's interest, could push up extension premiums, particularly for intermediate lease lengths. Key findings by economist Dr. Alexander Hamilton. Leaseholders under 80 years benefit, but savings are limited if deferment rates fall. Leaseholders with 81 to 150 years could see extension costs rise by 20 to 85%. Only those with very long leases, 150 plus years, consistently benefit under the reforms. If implemented as currently outlined, 63.5% of leaseholders could pay more, leading to a £3.14 billion increase in extension costs compared to the current system. What this means for property professionals. Time-sensitive planning is crucial for clients nearing lease extension decisions. Leaseholders in the 80 to 150 year bracket should get valuations under both regimes. Freeholders may push for deferment rates that favour their position, and the final government decision here is pivotal. The bottom line, LAFRA offers progress but also complexity. Until deferment and capitalisation rates are confirmed, many leaseholders could face higher, not lower costs. Clear advice and strategic timing will be key. The UK housing market is increasingly stagnant, with mobility rates at historic lows. And it's not just sentiment holding people back. Rising costs, market distortions and structural shifts have locked in homeowners, especially those with mortgages. Key reasons behind the slowdown: high transaction costs, especially stamp duty, make upgrading too expensive. Limited wage growth and tighter mortgage lending post-2008 have slowed equity building. The market relies on house price inflation to fund movement up the ladder, but that's no longer guaranteed. Many homeowners are now older and mortgage-free, a group far less likely to move. The numbers: 267,000 homes sold per quarter, well below pre-2008 norms, about 365,000. Mortgage movers, once the engine of the market, remain well below historic levels. First-time buyers are stuck longer in their starter homes, with fewer opportunities to trade up. The consequences: inefficient use of housing stock and reduced job mobility, falling tax revenues due to lower turnover, a broken housing ladder, where moving up is harder or out of reach. The stamp duty issue. Stamp duty land tax is now seen as a major barrier to movement, distorting behaviour and pricing. Reform proposals, like switching to a proportional property tax, exist but remain politically untouchable. Unless mortgage rates fall sharply or radical reform is enacted, expect continued low transaction volumes and increasing market stickiness, especially outside of inheritance-led moves or regional relocations. The implication for property professionals? With fewer movers and more stayers, opportunities lie in downsizing support, remortgaging advice, and repurposing homes to meet new lifestyle needs. Growth won't come from volume. It will come from service, innovation, and efficiency.
Subscribe to our newsletter to receive our weekly bulletins and stay ahead of what's shaping the super prime property market.